Hello and welcome everybody. Happy Friday. Hope everyone had a lovely week and is ready for a nice and restful weekend. The market has closed, but there are still some lessons to be shared before we all head off for the weekend, so that is why we're here. We're here to talk about what makes a good stock, well, good. We oftentimes want to be able to look at an investment or an investment opportunity and say, do I want to invest in that? Is there something possibly better? And the most important question, is now the right time and the right price? So what I want to share with you all today is a little bit more detail about how you can decide if a stock is good or not, and when you can decide if it's time to buy, sell, or just wait. So that's today's topic. It's going to be all about what makes a good stock good in terms of looking at fundamental analysis and technical analysis. So that is what we're going to be talking about today. Before we get into the presentation, I do want to say hello to everyone we have with us, because I saw one name that's definitely one that I've not seen in these webinars before. Hello Blaze, Maria, Romulo, Mao, Meli, Rosa, Riley, Marta, Iris, Eladia, Marta, Pablo, Yadira, Anna, Andrew, Dan, who is my dad. He is joining us today for today's webinar. Hello, Juan, Rocio, Wendy, Alexis, Kike, Elda. Wow, lots of new faces today. Rita, Mabel, Brenda, Nancy, my mother, Julie, and Belkis, and WC, and Lydia. Lots of new faces, and lots of returning ones. Thank you all so much for joining us today. I hope everyone learns something new in today's webinar, but I'm going to stop talking about that and start talking about this. What makes a good stock good? Well, before we get into it, there's two terms that I want to share with you all today. And these terms we're going to go into lots of detail about. So they are called fundamental analysis and technical analysis. Let's start off by just talking about fundamental, and then we'll get into technical later on. Fundamental analysis is a trading style where you look at what is the company made of? Like, when you want to start dating somebody, you don't just say, are they cute or not? You say, okay, are they funny? Are they easy to talk to? Do they like the same food? You look at a little bit more than just, well, are they pretty or not? So fundamental analysis is kind of like that, where you want to look underneath to see what is the true value of this company. Is it as valuable as you would like to think? And fundamental analysis doesn't just look at the stock, but also looks at the entire market, because it's very important to know if the market is doing well, or rather, is the stock doing well compared to the market? Is the market doing well and the stock's not? You want to be able to compare the two to know where this all falls. And yes, as my mom said, everything I'm sharing here is for educational purposes only. I will share some examples of charts and some examples of buy and sell signals, but please always do your research before you actually get into buying anything and come to your own conclusions. So, the goal of fundamental analysis is pretty simple. We want to find companies that are trading either undervalued or overvalued compared to their true value. So what that means is you want to find the good deals. It's like when you go to the thrift shop, you look around and you see something, you know that's worth money, or you know that you would love that, and they're selling it for 50 cents, $1. Score. Fundamental analysis is kind of like that. But for fundamental, there's two main categories that we have. The first is called quantitative analysis. The good way to remember that is quantitative, quantity. It talks about how much, it's the numbers. So quantitative is fundamental analysis looking at numbers. Then we have the qualitative, which is the fundamental analysis of quality. Or, how I like to remember it, quantitative is numbers, qualitative is words. So you could say, Jonathan is pretty young. That would be a qualitative analysis. Jonathan is young. Okay, that's great, but that doesn't tell me Jonathan is 25. That is quantitative. So quantitative is numbers, qualitative is words. Pretty simple. But when it comes down to looking at stocks, oftentimes we'll do a lot more quantitative than qualitative. Numbers are good because numbers let us compare them. We can compare the numbers of one company to another or find numbers that we like or don't like. So let's focus on the quantitative side of things for right now and for this presentation. So where do we get these magic numbers? Well, lucky for us, in order to be listed on the New York Stock Exchange or be a publicly traded company, the Securities and Exchange Commission, the SEC, requires that they publish reports. And they publish 4 reports a year. They publish 3 quarterlies and 1 annual. I apologize, it says publishes 3 reports. It should say 4 reports. 3 quarterlies, so quarter 1, quarter 2, and quarter 3. So think of it like January to March, April to June, July to September, October to December. But that last quarter, instead of saying how they did in October to December, instead, they're just going to smush the entire year together and give both the quarterly report and the yearly report in what's called a 10K, an annual report. So again, we have four sets of numbers per year. We have the 3 quarterlies, which are called 10K or 10Qs, and we have the 1 annual at the end of the year called a 10K. Now, where do you actually find all of this magic information? If you're crazy like me and you like going and reading a bunch of boring business papers, you can go to the SEC's website where you can find all of the listings for every single company, in addition to some other filings, such as 8Ks, which are reports when there is a change in leadership, maybe a board member left, maybe a new person came in to the board. All of that still needs to be filed, and you can find those in the form of 8Ks. But when it comes to the 10Qs and the 10Ks, that's what we like to focus on. That's where a lot of the number stuff comes from. And they contain a ton of awesome information for deciding, is this company worth investing in? The ones that I like to look for are cash flow, which is how much cash do they have? How much cash are they bringing in from sales? How much cash is going out? So how much are they spending? Which kind of leads into their profit and loss. Are they making money or are they losing money? Simple as that. And then other ones that are more qualitative. So these are our wordy answers, which is how risky is the market? Do they have competitors? Are their competitors growing? Was there a power outage that affected their company? All of this will be in the market risk section. And then also the management talks about the company. They say, I feel the company is doing very well, or I'm worried because whatever it might be. But the management talks about the company, and they will have that in both the 10Ks and in the form of shareholder meetings, where if you own a share or two, you can go and participate in them. Funny enough, Tesla's shareholder meeting, because of all of this quarantine stuff, they had a drive-in where if you owned a Tesla, you could drive up to a big board, basically, and you could watch Elon present on the status of Tesla from your car. And instead of clapping, you sat there and honked on the horn. I kid you not, it is worth going and finding some videos, because you see nothing but Elon Musk talking, and then instead of applause, you just hear a bunch of little car horns beeping from the audience. It is something else. But all of this is just a way of saying fundamentals are very, very valuable, and they are publicly available. You don't need a subscription to get them. These have to be made free of charge for anyone to view. So now, this is all great, but how does this help me to invest? Well, it helps you to find a company or stock's value. When it comes down to it, share price is the market value of that company. So while qualitative is kind of hard to pin down, because you can't say, if you said Jonathan is pretty young, well, that's a great range, but that also depends on how old you are. If you were 25, if you're the same age as me, you're probably not going to say Jonathan is pretty young. You're probably going to say Jonathan's the same age as me. If you were 15 years old, you may say, well, Jonathan's old. I'm already going gray, but you don't need to go that far. But if you're older, you may say Jonathan is pretty young. He's much younger than me. So it really depends on who you are or where you are. So quantitative is what we like to go on, because that lets us say, okay, 25 years old is still 25 years old. So that's a really easy thing to compare. We like numbers to compare against others. So when figuring out a company's value, there's a couple of numbers, or what's called metrics, that are very, very helpful. We have the price to earnings ratio, the earnings per share growth, and the dividend yield. Now, dividends are pretty simple. It's, we made money, let me give you a small share of that profit. But price to earnings and EPS might be a little bit trickier. Now, for some of you, this may be a review, but I want to make sure that anyone watching this later, or anyone that may not have seen some of the previous webinars, can still follow along with what we're sharing. So really quickly, I'm going to go through earnings per share and price to earnings. For earnings per share, it is a way of looking at the value of the company based on their business. Or really, how much money are they making compared to how many shares they have? So it's pretty simple to look at, because all we need to do is find their profit minus their dividend payments and then divided by shares. So it's their earnings divided by shares. Earnings per share. And the great thing about this is that you can look at earnings per share today, but you can also compare earnings per share to what it was last year or last quarter, which is called earnings per share growth. So we can look at earnings per share changes over time to see if a company is becoming more profitable or less profitable. Now, price to earnings is very similar, but also a little bit different. So price to earnings is not saying how profitable the company is. It's saying, how much am I willing to pay for that profit? Pretty simple to think about, but let me see if I can phrase it another way. it's very easy to think about price to earnings, where Kira has $1. I really like that $1 bill. She drew a nice little picture on it, you know. George Washington now has a little bow tie. It's really cute, and I want that dollar bill. How much am I willing to give her for that dollar bill? That's exactly how price to earnings works. To buy $1 worth of earnings of that company, how much am I willing to pay? So it's the stock price divided by the EPS, or the earnings per share, where the higher the price to earnings, the more expensive those shares are. So that is the basics of fundamental analysis. It is very deep because there's a lot of information you can go through. But it shouldn't scare you because of how much info there is. There are a few numbers you can look at, like price to earnings, like earnings per share, that will give you a lot of information about the company. So why is fundamental analysis great? Why is it worth using? Simple. Fundamentals do not change often. The price of a stock will change every single second. The fundamentals of a stock will only change once every 3 months, once every quarter. So because they don't change very often, we can use fundamental analysis to create a really good list of companies, where these companies, we can find a list one time and then look at that list over the coming days or weeks. And sure, there may be 1 or 2 small changes, but overall, that list won't change. So you can go in January and make a list of your top 20 companies, and then track those companies over the next few weeks or months to see if any of them ever go on buy signals. Don't worry, we'll talk about buy signals here in a minute. But really, this is looking for the gem companies. We're looking for the companies that have strong fundamentals, because on average, companies with strong fundamentals will tend to outperform, so they'll do better than, and also do better longer than other competitors that have worse fundamentals. Maybe not in the short term, but usually in the medium term and definitely in the long term. Companies that have strong fundamentals and can keep those fundamentals up will be the ones that continue to grow and succeed over time. And the last thing, but not usually one I focus on, but definitely worth mentioning, is that fundamental analysis includes company changes. For example, yes, there was a ton of stuff that went on with GameStop that wasn't just related to the company. But one of the big reasons GameStop did so well all of a sudden was that they had a person come over from another company. They have a new CEO. That is qualitative analysis. That is qualitative fundamental analysis. Now again, I don't expect you to be crazy like me and go to the SEC's website and start looking through all the fundamentals. There's an easier way for just finding the numbers you want. Websites such as FinViz offer company fundamentals in a very quick and easy way to read, but also will let you compare this company's fundamentals against other companies, against other companies in the same market or against the sector. And at the end of the presentation, I'll look through FinViz a little bit and show you how you can start doing fundamental analysis there. But we also have another thing to talk about: technical analysis. Technical analysis is slightly different. It's a way of investing that uses price and patterns to figure out your investments. So it's a little bit of looking at the picture and saying, what does this picture tell me? I'm getting flashbacks to art class. I'll tell you what, I failed kindergarten because I couldn't color inside the lines. So I'm not very good at art, but technical analysis is fun. So the simplest form of technical analysis is looking at charts. Thankfully, it's not pictures, it's charts. And to do this, we have four main types. We have line charts, bar charts, candlestick charts, and point and figure. And while all of these have some similarities and some differences, all of them do the exact same thing. They allow us to look at how the price of the stock has changed over time, and they let us look at the chart and find price patterns to find buy and sell signals. Now, let's quickly go through these four different types. I don't want to bore you with the details because I'd rather talk about why these matter, not what they are. Line chart is this crazy jagged little line. The nice thing about it is it's easy to read and it's easy to understand. If you asked someone what you think a stock chart looks like, this is probably what they're going to say. Unless, of course, you keep up with Sectors Made Simple, because then you know more about charts. But if you ask a 10-year-old kid, what does a stock chart look like? They're going to draw you a line chart. And it shows price changes over time, where each of these little points is one day, and you just play connect the dots. So in this chart that you see here, 1 point is every day. But you could also have it where we have 1 point a week, 1 point a month, 1 point a year. And again, all that means is you have one price for that entire week. Then next week, another point, another point, another point, and then you play connect the dots. Danny is asking, can I incorporate Be a Profit to the Matrix? Yes. One of the first members webinars, I think actually the first webinar I gave for the members is on using Be a Profit with the Matrix and how you can use FinViz to set up a screener for the Matrix. So after this webinar, go take a look at that one because that one will have all of the answers you need. And if there's anything that you still have questions about after, please shoot me an email. I'd be more than happy to talk about that with you there. So, line chart is the basics. This is, if you asked a 5-year-old what a chart looks like, this is what they would show you. Now, one step up. We have a bar chart. This, still, every single one of these lines is the price changes in one day. But now we have a few more things. We have a little line that goes out to the left, which is the price the price that stock opened at. So, ding 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 ding, they ring the bell. Boom. That little tick off to the left is the price it opens at. The stick, the top of that stick is the highest price it got to. The bottom of the stick is the lowest price it got to. And then the tick on the right is the price that it closed at. So we have open, high, low, close, or OHLC. So bar charts are great because they give us, instead of just one piece of information per day, we have four rather. We have the open, high, low, and close, where every single period, in this case a day, is one line, and the line is drawn between the high and the low prices of that day. whereas the little feet that go off to the right and left show us the open and close prices. Everyone still with me? All right. Now, candlesticks. These look like, well, a candle. It is the same kind of information as our other chart, where this one has OHLC, open, high, low, close changes, but instead of it being two little feet and a line, we now have blocks, little boxes, where each period is one of these candles. Now, the body of this is slightly different. It's very easy to see days when the market went up and when the stock went up and the stock goes down. If we have a solid body, if it's filled in with color, that means that it closed below the open, so it went down. If it's a hollow body, that means the price went up. And that is exactly how you would read this. And the string, the little tail on either side, is the high and low. Moving right along, we have my favorite type of chart, point and figure. This kind of chart, instead of just showing the price changes over time, instead it now looks at the price changes period. And the way that it keeps track is it says, I don't care if you changed 0.1%. I don't care if you only gained 5% or like 0.05. I only care when something happens. It's like the super lazy person that just sits there, the super lazy teacher that just says, just wake me up when the bell rings. That's exactly what this is. We sit here and do nothing, and then when the price changes enough for us to care really, we then do something on the chart. We have a game of X's and O's here, where new boxes are drawn when the price goes above or below a certain price. So the great thing about these charts is it shows a lot of detail when there's a lot of price changes. For example, all of 2019 takes place between here and here. 2020, this chart only goes up to the beginning of July, but still, this is all of 2020. So when there's a lot of stuff going on, the person is sitting there frantically writing notes. When there's not as much to talk about, nothing happens. So it's a lot easier to see when things happen as opposed to just being overwhelmed by all of these points for no real story. Why have I gone through all of these different types of charts? Because I love point and figure, but you may like candlestick. You may like line or bar charts. And technical analysis can be done with any of them. It's not just one type of chart. So I want to share with you all what's called chart patterns. Chart patterns are an easy way to find important things in charts. Now, of course, the easiest thing to say is tell me when to buy and tell me when to sell. Buy and sell signals. Those are the clearest or most used chart patterns. And the goal of it is to help us find where the short-term direction turns into long-term trend. Now, chart patterns, will tend to be one or the other. It'll either always be in a buy signal, or it'll be in a buy signal till it's in a sell, or it'll be in a sell signal till it's in a buy. And these signals are useful for just saying, should I buy or should I sell? But we can take it a step further and do other calculations or create fundamental analysis numbers using technical analysis. That's kind of where both pieces come into it, where it doesn't help to just be fundamental, it doesn't help to just be technical. Borrowing from both is oftentimes the best way to go. But again, I said that I love point and figure, so I'm going to share with you all what buy and sell signals look like in point and figure, and then go into a few examples of what they could look like on other charts. A buy signal for point and figure is pretty simple. It's where a column of X's goes above the previous, or when it breaks what's called a resistance barrier. Now, here we have an example of a chart. We have a price that went up to $166 over here in the left. Then the price went back down. It went from 166 down to 160. Now the price starts to go back up. So what we now have is a resistance barrier where you see the green line. Because remember, a buy signal is when a column of X's goes above the previous. The buy signal here is when the price goes above the 168 line. Josefina, I see that question. I promise I will answer that when we go look at FinViz, because I'll show you on FinViz where you can find the volatility. But to learn more about that, I also gave a webinar about a month and a half ago where I compare volatility and beta, where they're useful and where they're not. Kira, would you be able to find a link for that one, please? Nah, she'll hear it when she catches up to the webinar. So all of this that I'm showing here is the simplest buy signal that you can have, where our current column of X's goes above the previous column of X's. This is what's called a breakout. In this case, a double top breakout. On the opposite side, we have our sell signals. Sell signals are the opposite. It's where our column of O's goes below the previous column of O's. Or instead of having a resistance barrier where you're trying to push through a resistance, aka a ceiling, here we're trying to break through the floor or the support. So support tries to keep it up, resistance tries to keep it down. An example is what you see over on the right. The price went up to $92, then went back down to $89. Now it reversed back up again. So we have a resistance barrier set below that level, below the 89. So the sell signal is when the price goes below that 89, or what is called a double bottom breakdown. Now, again, breakouts and breakdowns are not just in point and figure charts. These are, and really I should say, resistance and support barriers are not just point and figure. These are things that, while there are some that are specific to specific types of charts, like the candlestick 3-line strike, some are based entirely on the chart itself. It's only about that chart how it looks, and what you learn for point and figure would work for candlestick, would work for line, so on and so forth. These are, and this is not all of them, these are just some examples. Double top breakout will apply to all types of charts. Cup and handle will apply to line, candlestick, and bar charts. But again, these are just the easiest examples. To learn more about point and figure buy and sell signals, I recommend you go and take a look at one of our past webinars, point and figure buy and sell signals. That will teach you all about what a double top breakout looks like, and what a triple top breakout looks like, and what a quadruple top. There's lots of different types that have different amounts of meaning depending on how long and how many times that resistance barrier was hit but not passed. What I'm trying to show you here is that all of this is what's called chart patterns, technical patterns. But we can also look at other things, which are called technical indicators. Technical indicators are based on our price patterns. They look at how the price has done in the past to try and figure out how it may do in the future. Now, instead of finding patterns, instead of looking for a double top breakout, for example, indicators are often formulas or math calculations that are done to try and give some meaning to the chart. For example, think about it, your car. You don't say, my car can go 70 miles an hour. I hope your car can go 70 miles an hour, otherwise you're not going to be on the freeway. What you're going to say is, my car can go 0 to 60 in 6 seconds. My car can go 0 to 60 in 4 seconds. How fast it gets somewhere. That's as important as, well, can it go 70 miles an hour? So technical indicators can be like that 0 to 60. It's how fast did it get there? How slow did it get there? Once it's there, how long does it stay there? And all of these are very useful when you want to try and find buy and sell points for stocks. Now, there's two main categories for technical indicators, just like we had for our fundamentals, but slightly different. We have one, which is overlays. These are indicators that are put on the same chart. They're usually put on top of the price, hence the word overlay, and will show some change in price over time. Then we have oscillators, which is indicators with their own scale. These will be below the chart and will have their own little, song and dance. I'm not going to be able to go into complete detail about all of these, but for members, if you're interested to learn more about these indicators, I go into incredible detail about all of these indicators and oscillators that we're about to talk about in one of my previous webinars, which was on Technical Analysis Indicators, I believe was the title of that one. I got it. Awesome, thank you. Again, members can go and watch that webinar whenever you'd like. And non-members, if you're interested in the kind of content we offer, I recommend seeing if you want to subscribe, because we have about 25 hours of free webinars, but also about 25 hours of paid webinars as well, that you get all available whenever you want as part of your subscription. All right, sales pitch over. Let's get back to our overlays and oscillators. Some examples of overlays, and one of the most useful in my mind is the moving average. And I'll actually show some examples and whatnot of this one in a minute. Then we also have pivot points. We have the parabolic SAR, SAR, which stands for stop and reverse. And then for oscillators, we have MACD, which is based on the moving average, but it's how is the moving average changing? And then we have the relative strength index oscillator. Again, all of these I go into an incredible amount of detail in the webinar from September 22nd. Thank you so much for that, Lucia. You are our little librarian of all of our content. You are incredible. Thank you. Thank you for pointing all of the dates out for that. That is super helpful. So again, I'm not going to go into a crazy amount of detail on these. I don't really have the time. Not because I don't like you, but because we have other stuff to talk about. But again, there is an entire hour-long webinar all about this. Glenda, the From Student to Investor lessons are all on Facebook. You can find those on my mom's Facebook, Julie Stav Inc., I believe. Yes, Julie Stav Inc. Awesome. So let's talk moving average. Moving average is my favorite overlay. My favorite fundamental analysis, technical analysis thing to look at. Because it is the change in closing price over a period of time, or rather the average closing price over a period of time. So you may say, in the past 50 days, the average closing price was $100. That's awesome. That lets you see, well, the average has been 100. Am I over the average? So am I at 105, 110? Or am I below the average? 90, 95. And then as a market day closes, we add another day. We always will have the same number of days. So it may be 50 days. Awesome. Add on one day, click off the last. So it's, well, a moving average. It's an average of 50 days, 20 days, 200 days, where when one new day is added, the old one gets pushed off. And there's two main types. We have the simple moving average, which is simple. Add up all the prices, divide it by the number of days, and it will give you the average of that period. So a 50-day moving average is all of the closing prices divided by 50. Then we have what's called the exponential moving average. The way I like to think about exponential moving average is by asking you this question. What did you have for dinner last night? I bet you most of you can tell me what you had for dinner last night. Can you tell me what you had for breakfast yesterday? Probably. Can you tell me what you had for dinner last Friday night? All right, maybe getting a little bit trickier. Can you tell me what you had for dinner 3 months ago on December 28th? If you can, I'm impressed. But exponential moving average is pretty simple to understand. It forgets the old stuff, but remembers the new stuff a lot better. So it gives more value to the newer close prices. What the price was yesterday matters a lot more than what the average was, or what the price was 50 days ago. So it relies on what's called a smoothing factor, or I like to think of it as the forgetfulness. I am very forgetful. I can't tell you what I had for dinner 3 nights ago. No. I can tell you what I had for dinner last night, though. So the bigger the smoothing factor, the more importance is given on the new day, and the more forgetful it is as the days get older and older. Let's look at what this would look like on an actual chart. So here we have a 2-week look at the S&P 500, where it starts on the 3rd of September and ends on the end of the trading day on the 17th. And the jagged blue line is our price changes. That is the actual price at any time for our SPY ETF. The line you see in purple is our moving average. It is our 50-day simple moving average. The green line is our exponential moving average. Now, look at a couple of very important things here. I like to look at what happened here at the end of 9/7. The end of 9/4, my apologies. The price in the afternoon shot up very quickly. The purple line, it took it a little bit to catch up, whereas the green line, it figured it out pretty quick. But when the market opened on the 8th, the price shot down. The purple line took a little bit longer to figure out what was going on. The green line reacted much faster. Exponential moving average will react faster if things change. The simple moving average will just be that. It doesn't care if the market had one crazy day. It's just one day in a list of many. Now, these are some examples of how simple moving average or moving averages can be used. This is by no means all of the options you have, and these are only for educational purposes. Please keep that in mind. One way is as a market indicator. Meb Faber had an idea that you can make investing simpler by just trading like a robot. And the way he decided if he even wanted to trade at all, so he woke up, checked one thing and said, all right, I'm going to trade today. Or, maybe not today. Let's check tomorrow. Was he checked if the price of the S&P 500 was above or below the 10-month simple moving average. If it was above the 10-month simple moving average, he would go and trade. If not, he didn't trade. The groundhog saw his shadow. We have another 3 months of winter. It can also be used as a support and a resistance barrier. If the price goes above the 10-day simple moving average, okay, that might be a buy signal. If it falls below the 50-day moving average, all right, that's getting a little scary. And it can also be used to find buy signals, where you can say, I may buy if the price goes above a certain moving average. I might sell if it goes below a certain moving average. And then you can also compare two different moving averages, like we did on the other chart, where we looked at it and said, here they cross. Here they cross. Here they cross. So you could say, when does the long term start to catch up? Monica, you can use either or. So you can use a 10-day moving average or 10-week. There is no one right one. There are some that are very commonly used. The 10-day exponential moving average is pretty commonly used. The 2-month moving average, and then the 252 simple moving average. 252 is the amount of trading days in a year. So typically they'll use that to say, what was the simple moving average for the 1 year? Which one is better, simple moving average or exponential moving average? Exponential moving average I tend to use for shorter term. Simple moving average I tend to use for a bit longer term. So again, this was one example of how moving average can be used. This is something that is very easy to start using because it's an overlay that you can set up on Finance Yahoo or other chart making sites. And I'll go into an example of that after this. But why is technical analysis good? It's an easy way to see a change in market behavior or attitude. You get to see not what were the fundamentals 3 months ago when they took that report, but what do investors think today about the price and the performance of this company? And we can use past chart patterns or past signals to try and predict future direction. Now keep in mind, there is no magic ball, there is no get-rich-quick scheme. This is always guesses when it comes down to it. But we can do our research to try and improve our odds. And my favorite part about technical analysis is it lets you say, should I buy now or should I sell? Because again, with fundamental analysis, it's awesome at helping you pick a list of companies. But when do I buy those companies? Is it a good time to buy that company now? Technical analysis helps you answer that, where different indicators and patterns can be used together to see how many signals agree. So you may say, all right, you five, show of hands, who wants steak for dinner tonight? 3 of them raise their hands, 2 of them don't. Awesome. Now I know. So you can get multiple opinions of the same question. Should I buy or should I sell? Where all of these different indicators may say the same thing, may say slightly different things, but all of it can be put together to come up with a decision. And of course, past results cannot guarantee future performance. Quiz time. Actually, I see Pablo's question. When I buy stock and if I'm not going to let it go to the 50-day moving average because I don't want to lose my profits, is it still important to pay attention to it? It's always good to pay attention to things that you're investing in because it's very rare that a stock's price changes significantly, but it can always happen. You can set an alert to have it alert you when it goes below the 50-day moving average, and that's going to be very helpful. But the price may not just stop right below the 50-day moving average. It may just continue going down by the time you finally see it. So there's something to be said for setting trailing stops, which are automatic sell decisions when the stock price falls below a certain point from its highest. So trailing stops are sell signals that you don't need to be at your computer to have it sell. It would just automatically sell it if the price drops too much. Quiz time. I have 3 questions and then we're going to go over and look at some charts. Are these examples of technical or fundamental analysis? Jonathan, me, finds company A has strong earnings growth over time. So I look at company A and I see that its earnings have been going up over time. Technical or fundamental? The answer to this one is fundamental. Earnings per share growth over time is fundamental analysis. Those are numbers that you will find looking at the 10Ks and 10Qs, and is an example of fundamental analysis. Question B. Jonathan finds that company B is approaching a double top breakout. Technical or fundamental? A double top breakout is an example of a technical chart pattern. So this is our chart signal. This is where we see that company B's price is going somewhere. So anytime you're talking about the price of something, it will be a technical indicator. Last question. When I want to compare the price to earnings ratio between company B and its sector, is that technical or fundamental? Also, while all of you guys are putting your answers in chat, I would love it if you could give this video a like on YouTube. The algorithm likes it, and it shows Google that you like what we're sharing. This information we offer every Friday for free, and by liking the video, it makes it seem like people like the video. So it will suggest it to more people, so more people can come and learn along with us. So if you can, give us a like. If you really want to, give us a subscribe. It doesn't cost anything to subscribe on YouTube, and it will let you know every time we go live, which is every Friday at 4 p.m. Los Angeles time. So, price to earnings ratio is a fundamental analysis. That is a quantitative fundamental analysis. So, fundamental. Let's go now and look at some things together. First, I want to start with where you can go to find fundamental analysis numbers. You can go here to FinViz, and you can look at a company's chart, which is technical. But if you scroll down, right here is all of your fundamental analysis numbers. You have your price to earnings, you have your earnings per share, you have your earnings per share growth, and someone was asking about stocks volatility. We have here the beta, which is how much does the price of this company change compared to the market on average. So over the past 5 years, Apple's price changes about 24% more than the S&P 500. If the number is 1, it changes the same. Less than 1 changes less. More than 1 changes more. So this is where you can find fundamental numbers. If you want to compare the price to earnings against its sector, you can go up here to groups, scroll down here to price to earnings, and then we can go here to custom. And this will list out the price to earnings for the different 11 sectors. And you can also choose between different industries within these sectors. If you want to start doing fundamental analysis to make a list of companies, you can go here to Screener and put in all of your fundamental, and hey, how about some technical metrics while we're here as well? You can do the two together to create your list of companies. For more information on how you can set up one of these screeners, if you aren't a member, last Friday's webinar, I talked about this in a little bit more detail. But if you are a member, I recommend you take a look at that webinar that we linked earlier on in this webinar, which is all about fundamental analysis with the matrix. It was the first members webinar we've done, second members webinar we did. And now let's go look at stock charts to see our fundamental analysis indicator or technical analysis indicators. So I'm just going to do a normal sharp chart, and it already adds a couple for us. Down here, we see our oscillators. So these down here are our oscillators. I think there's 2 L's. I don't know what it did there. But these are the oscillators. And then up here, The blue line that you see is the 50-day moving average. The red line that you can barely see is the 200-day. And if we go down here to overlays, we can choose simple moving average, exponential moving average, and then how many days you want for that indicator. For that overlay. So this is how you can start doing technical analysis. You can do it right here. And again, there are also your indicators down here for relative strength index, your moving average, convergence, divergence, and all of that. But again, for more detail on that, members, I do have a webinar going into all of the examples and where these can be used and how they can be used over in the webinar section on our website. If you are new and you don't know about our website, right over here at sectorsmadesimple.com, you can go to webinars and you can see all of the free webinars that we have done in the past, what they were about, some are in Spanish, and then the links to watch those webinars. If you are a member and you log into our site, this page will also have all of the members' webinars. And we always have a link to join the next webinar for both free and members sessions. So if we clicked on here, oh hey, that's us right now. So that's all I have to share with you all today. I hope everyone learned something new about either technical analysis or fundamental analysis. But all of this is information that can be used to compare one stock, to compare stocks against other stocks. But all of it is in an effort to make your investment decisions a little bit more confident and a little bit more simple. So thank you all so much for joining us today. Members, a fun webinar will be coming up on Tuesday where my mom, Julie Stav, will be giving a webinar to all of you, presenting on a topic that she's wanted to talk about for weeks and will finally be getting to share with you all. So next Tuesday's webinar will be with my mom, Julie Stav, and next Friday, I hope to see you all back here for another free webinar. Again, if you ever want to, you're always welcome to share these free webinar links with friends or to encourage others to come join us. I love being able to share this information with you all, and getting to share it with more people is always a blast. If you have any questions, please feel free to shoot us an email at support@sectorsmadesimple.com, and we'll see you all very soon. Thank you all so much.